Hey there, and welcome back to News Nexus, the place where we break down the most important topics in the world of finance, business, and investing. I'm Emma, and today we're diving into something that's been a tried and true method for building wealth: real estate. Whether you're looking to earn passive income, grow your investment portfolio, or build long-term wealth, real estate is one of the most lucrative ways to do so. But where do you even start? What kind of real estate should you invest in? And how do you navigate this complex, sometimes intimidating world? Well, in today's video, we'll answer all those questions and more, breaking down how to get started with real estate investing, what strategies to use, and how to maximize your returns. So grab your notepad and let's dive in. First off, let's take a look at the basics of real estate investment. At its core, real estate investing is all about buying property, whether that's a home, commercial space, or something else, and using it to generate profit. There are three main ways people make money in real estate: appreciation, cash flow, and equity buildup. Appreciation is the increase in the property's value over time. Cash flow is the money you make from renting out the property. And equity buildup is the amount of your mortgage that's paid down over time, which increases your ownership stake in the property. So whether you're flipping houses or holding properties for rental income, real estate can provide a reliable, long-term investment opportunity. But how do you know which route is best for you? Let's start by looking at the different types of real estate you can invest in. First, we have residential real estate, which is what most people think of when they imagine investing in property. This includes single-family homes, multifamily units like duplexes and triplexes, and even larger apartment complexes. Residential real estate is often the easiest for beginners to get into, and it can provide a steady stream of rental income. Next, there's commercial real estate. This category includes office buildings, retail spaces, industrial properties, and multifamily units with more than 4 units. Commercial properties generally require more upfront capital, but they can offer higher returns thanks to longer lease terms and higher rental rates. Commercial properties can also come with professional tenants, businesses that are leasing the space, and in some cases, commercial properties are easier to manage than residential units, as you don't have to worry about things like tenants calling you for small repairs at 2 a.m. But what if you don't have the capital for buying properties outright, or if you don't want to deal with the day-to-day management of real estate? That's where REITs, or real estate investment trusts, come in. REITs are companies that own, operate, or finance real estate that generates income. When you invest in a REIT, you're essentially buying shares of a company that invests in real estate on your behalf. One of the major perks of REITs is that they provide an easy entry point for people who don't have the resources to buy properties directly. And the best part? You can invest in REITs just like stocks, which means you can sell them anytime you want. For those of you who like the idea of pooling resources with others, there's also real estate crowdfunding. This model allows you to invest in larger real estate projects by contributing a small amount of capital along with a group of other investors. Real estate crowdfunding platforms have made it possible for people to invest in high-value projects that they couldn't afford on their own, such as commercial developments or large residential buildings. Crowdfunding can be a great option if you're looking for diversification and want to access properties without the headache of managing them. Now that we know the different types of real estate investments, let's talk about how to choose the right strategy for you. Your choice depends on a few factors, including your financial goals, the time you're willing to commit, and your risk tolerance. If you're looking for consistent income with relatively low risk, residential real estate might be your best bet. On the other hand, if you're aiming for higher returns and can handle a bit more risk, commercial real estate or flipping houses might be a better fit. And don't forget to think about whether you want to manage the property yourself or hire someone to do it for you. Property management companies can handle everything from finding tenants to collecting rent, but they do charge a fee, usually around 10% of the monthly rental income. Once you've decided on a strategy, it's time to think about financing your investment. Most real estate investors don't pay all cash up front. Instead, they use financing options like mortgages. If you're buying a single-family home or small multifamily property, you'll likely use a traditional mortgage, which typically requires a down payment of 20%. You'll also need to have a solid credit score and a stable income to get approved. But what if you don't want to wait for a mortgage? That's where hard money loans come in. These are short-term loans offered by private lenders and are often used by investors who are looking to flip properties quickly or take on a renovation project. However, they come with higher interest rates and are more expensive than traditional loans, so they're best used when you need capital quickly and can pay it back in the short term. If you don't have enough capital on your own, you might consider partnering up with other investors. Partnerships are a great way to pool resources, share responsibilities, and tackle larger projects together. Just make sure you have clear terms outlined in a legal agreement to avoid conflicts down the road. Now that you've got your financing sorted, let's talk about location. When it comes to real estate, location is everything. You want to invest in areas with strong growth potential, good schools, low crime rates, and easy access to amenities like shopping centers, transportation, and healthcare. For instance, cities that are growing in industries like tech or healthcare tend to see rising property values, which means your investment is more likely to appreciate over time. Once you've secured your property, it's time to focus on property management. If you're renting out residential properties, you'll need to find tenants, handle maintenance, and make sure everything runs smoothly. This can be time-consuming, especially if you're managing multiple properties. If you prefer a more hands-off approach, hiring a property management company might be a good option. They'll take care of the day-to-day tasks, from screening tenants to handling repairs, for a fee. Lastly, don't forget about the tax implications of investing in real estate. There are lots of tax advantages to owning property, like deducting mortgage interest and property taxes, as well as taking advantage of depreciation. However, your rental income will be taxed, so it's important to have a strategy in place. I recommend consulting with a tax advisor to make sure you're maximizing your deductions and taking advantage of programs like the 1031 exchange, which allows you to defer taxes when you reinvest in another property. Real estate investing can be a powerful way to build wealth over time, but it's important to do your research, understand the different types of investments, and find the right strategy for your goals. Whether you're just getting started or you're already an experienced investor, there's always more to learn and new opportunities to explore. So if you enjoyed today's video and want to learn more about real estate or other investment strategies, make sure to hit that subscribe button and give this video a thumbs up. And leave me a comment below. What type of real estate investment are you most interested in? I'd love to hear your thoughts. Until next time, this is Emma from News Nexus, reminding you to invest smart and stay informed.